Silver has been the best performing commodity of 2016, and in appreciation of our listeners, Palisade Radio and Palisade Research are giving away a free American Eagle 1-ounce silver round each and every week for the rest of the year. Just visit palisaderadio.com and enter your email for a chance to win. Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Today we have Rick Rule on Skype for our monthly Palisade Sprott market update. And before starting, I just want to announce that Leo from Napa Valley is the winner of our 1-ounce silver round this week. If you'd like to sign up to win a free ounce of silver, just visit palisaderadio.com and follow the link to the sign up. You'll also receive a 15-page report on investing in silver. Rick, thanks for coming back on the show.
Always a pleasure, Colin. Thank you.
I want to start off with getting a sense of where we are in the market. We've had, I guess, two and a half months now of a pullback after what was maybe a run that was too much too quickly. And you were making some comparisons that I found very interesting prior to hitting record here about times in the past, and that maybe the U.S. dollar is going to hold us in a bit of a pattern here before we blast off again. Rick, where do you think we're at right now?
Well, Colin, I think your observation is accurate. I think that what we enjoyed in the gold equities market in particular was too far too fast. And the consolidation that we're seeing now is normal and natural and, in fact, healthy for a gold bull market. And as you pointed out, I think I've seen this occur twice before in my career, Colin. Hindsight, of course, will be 20/20. So 2 years from now, we'll know if what I'm saying today is daft or not. But I see a situation where, with a little interest rate rise at the end of the year, which is looking likely, but more particularly with chaos in Europe, trauma on the peripheries of the European Union, that perhaps €1 trillion out of 15 or 16 trillion euros in investable capital in Europe likely leaves Europe and comes to North America in the next 12 to 18 months. So I see a circumstance where the dollar is relatively strong, but gold does relatively well in dollar terms, which means it might do very well in other currency terms. I've seen this twice before in my career. Mid to late 1975 and early 1976 was the first time I saw it. I was too inexperienced to know what it meant. But I saw it again in 2002. And the end of that trade comes with the dollar going lower as well and gold doing very well. And I sort of suspect that past is prologue, because I don't see U.S. dollars, particularly as expressed by U.S. treasuries, as being particularly good instruments for investing in their own right. So I think that the dollar will do relatively well for 12 months, given the weakness in other currencies, but that dollar-denominated gilts, that is the U.S. 10-year treasury, ultimately aren't particularly good instruments. So I see sort of, 10, 12, 14, 18 months out, the dollar rolling over 2 and gold doing very well, which should, of course, be very good for the gold equities.
Rick, on a previous interview, you had voiced some disappointment in the UK for exiting the euro in terms of implications that it would have on the UK and Europe. We now have a situation where I believe Italy is coming to a vote in the coming months here on potentially following suit. If Italy goes forward, it looks like the euro as it exists today will look very different in a few years from now. Since we're talking about the U.S. dollar, I assume that another country leaving might be further fuel for the U.S. dollar.
Well, I think that's right. And I should correct the impression that I left on that show. I wasn't particularly aggrieved, if that's the right phrase, over the Britons leaving the European Economic Community. I was bothered by this sort of xenophobic, anti-trade, anti-immigrant impetus in the Leave campaign. I believe that free movement of people and free movement of capital is essential for the ascent of mankind. To the extent that the vote was about leaving behind that fourth layer of government in Brussels, I'm all for it. Now, beyond my own personal preference, it would appear that there are very strong centrifugal forces in Europe, which makes some sense. To the extent that those centrifugal forces come apart, there are a few circumstances that the market needs to consider. One is the creditworthiness of the people who are likely to leave the Union, those countries on the peripheral, places like Greece, places like Portugal, places like Italy. I would suspect that as sovereign borrowers, their credit ratings will be substantially worse than their credit ratings as part of the euro. And one wonders how they will monetize the deficits which they are certain to incur in the next 5 years. A second question really has to do with how does the world economy deal with a contraction in the European economy, which would certainly occur as a consequence of the end of the European free trade zone. I guess the third circumstance would simply be the hesitancy that people had with regards to savings and investment in anticipation of the first two consequences of centrifugal forces in Europe. All things considered, I think in the near term, that's probably bullish for the US dollar and bullish for gold.
For the remainder of today's interview, I thought we'd change things up, do a bit of a rapid fire approach, and I'm going to name a commodity. And then, Rick, you can provide your thoughts on maybe timing, price levels, investing approach, whatever you want to talk about. Just so you know, I have 8 commodities listed to give you an idea on timing to be spent on each one. And feel free to be brutally honest if there's any of them you particularly dislike. Let's start with an obvious one, just being gold.
I think gold, I feel like gold may be flat for 12 months. The gold stocks may be lower before they're higher. I feel very good about the gold price in the 1.5 to 3 year time frame.
Okay, and what about silver?
Silver probably outpaces gold in both directions. If gold stays flat, it wouldn't surprise me to see the silver price fall. If the silver price falls, it wouldn't surprise me to see the silver equities fall harder. But when gold starts to run, I suspect that silver will outpace it on the upside. And silver companies, silver equities are very, very rare. So if you're looking in the 12 to 24 month time frame, the silver equities are probably a good place to be, but maybe lower before they're higher.
Moving over to base metals, let's talk about copper.
Demand is missing for copper, which is problematic. But the copper industry is uneconomic as an industry as a whole at this price point. What we're going to begin to see, in fact, what we're seeing today is demand destruction. This will take a long time to wind its way through in the market. But I suspect that more money will be made in the copper business than any other mineral commodity over the next 5 or 6 years. It just won't come quickly or easily.
A semi-related commodity in terms of oftentimes mined alongside copper, nickel.
I think the recovery in nickel is going to come more quickly. Certainly the moves in the Philippines and Indonesia to do two things: to restrict the worst excesses that happen in the laterite mining business, the worst environmental degradation that happens there, and also to demand local beneficiation of oxidized nickel ores. I think will lead to some artificial tightening in the nickel market. Although I don't see a recovery in demand, what I do see is supply disruptions coming sooner rather than later.
As if we have not beaten this one to death, I like it so much, so I'll bring it up again. What about uranium?
I love the uranium business, but it's pretty clear that some of the Japanese inventories that got made surplus as a consequence of the shutdown in Fukushima are finding their way on world markets. We're seeing a situation now where the uranium price is hovering about $20 a pound. It takes the industry about $60 to make it. So you make it for 60, sell it for 20, lose $40 a pound. At some point in time, that's going to come to a screeching halt. But it doesn't have to come to a screeching halt immediately. We like this theme enough at Sprott that we're spending an awful lot of money preparing a really comprehensive study on uranium that we hope to be able to introduce to the market early next summer, say June-ish. You know, the uranium business has treated me very, very, very well in the past. And I think when the uranium market gets underway, that there are enough wealthy investors who have a memory of the last bull market, that the response will be extraordinary. I just don't think it'll be soon.
Rick, one could call it a bubble, and gains have been pretty incredible over the past year. I'm talking about lithium, of course. What do you think of lithium?
By and large, a joke. The four largest lithium producers worldwide are concerned about an oversupply, while all the companies that don't have any lithium are talking about a shortage. The truth is that if you throw capital at the proved undeveloped resources of lithium, in other words, if you throw processing capital at the business, we can take care of any near-term shortfall. It's important to note that sort of, the lithium battery is by weight about 3 or 4% lithium. If you like the lithium battery as a storage mechanism and a mechanism for real growth and utilization, you ought to really, really, really like nickel and cobalt.
Well, you named the next commodity that I'm going to ask you about, cobalt. We'll be putting out a special report on that with Palisade Research this week, and that is a much bigger component of a battery than lithium. Rick, what do you think of cobalt moving forward?
I like the cobalt business. I think that most of the future of cobalt really takes place in Russia and Congo. The truth is that the grades and the size of the deposits in those terrains, rough terrains, of course, are substantial. Those two countries have easily 100% of the lowest cost quartile cobalt in the world. I think in cobalt, you're in an interesting position. If you scale up really reliable production of cobalt, I think you increase use. Sort of like if you build it, they will come. What I think will happen, of course, is that lousy cobalt deposits in better jurisdictions, Canada, Australia, Brazil, will be an interesting stock market theme. And I think one real interesting thing that issuers might be able to do is to explore for high quality nickel deposits by calling their company so-and-so Cobalt. I like the idea of doing mafic and ultramafic exploration under the guise of whatever the most popular metal in the suite is, while you're actually looking for nickel copper deposits.
Rick, changing gears a bit, ag minerals.
Ag minerals are way, way, way oversold. Every day we get more people on Earth. All of those people want to eat. The phosphate business is underwater. The potash business is underwater. So what we're trying to do at Sprott is look for deposits that would make good money and could be buildable with regards to infrastructure at more normalized potash and phosphate prices. The decline in the prices of soft commodities and the price war in particular in the potash business has set the stage, I think, for the same kind of dramatic recovery in ag minerals prices that we saw at the beginning of the last decade. We're really attracted to this, although, again, I think it's a 2 or 3 year play. But it's something that the industry has moved away from because of their fascination with gold and silver. And as a consequence of that, we're moving towards it.
I've added a ninth one to the list, and that's rare earths. You've said before they're not rare. The market hates them right now. Do you have any love for rare earths?
I don't think the market hates them enough. They're not particularly rare. The Chinese tried to restrict supply. That didn't work particularly well. So the Chinese came and bought back market share. Any price strength will be met by lots of discoveries and lots of production anywhere there's pegmatites. I've joked in the past that the most common rare earths, of course, in stock promotion are fraudulent, thorium, and scandium. That's probably a bit harsh, but people should stick to real metals with real markets for the most part.
I just read Jim Rickard's new book called The Road to Ruin in preparing for an interview with Jim in the coming weeks. It's not released yet, but wow, it was just a fantastic book. In fact, I think it's his best one that he's done so far. I'm not sure if you've had a chance to read it, Rick, but the book is very gloom, doom, and Jim paints a picture from several different angles of essentially an imminent market crash due to the complexity of derivatives and the world that we live in. I shouldn't say imminent, an inevitable market crash at some point in the next couple years. And everything really leads back to gold, and I think this is a good way to leave this interview, that being in commodities right now really seems like the right place to be, and it's hard to find anything else that has that level of certainty that one can feel when they get acquainted with the precious metals and other commodities.
Well, I would urge your listeners to tune in to the Rickards interview. I think whether or not you agree with his point of view, that you have to listen to him, because even if it isn't a certainty, it's certainly a contingency worth insuring against. And Jim is unusually good in his ability to make complex topics understandable. And secondly, his background, particularly his background as counsel for long-term capital management, gives him a unique view into the workings of the financial services industry. So people owe it to themselves and their families to take a listen and really, really come to understand the message that he has.
Listeners who have questions for Rick, I just want to remind everybody they can always email me at colin@palisadeglobal.com. We do this interview with Rick every single month. He's nice enough to come on and spend half an hour of his time. If you do have a question, I'd be happy to ask it for you to Rick on next month's show. Rick, thank you so much for coming on the program as always.
Always a pleasure, Colin. Thank you.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?